The big news this week in housing is the closing of Silicon Valley Bank, followed Sunday by the closing of Signature Bank here in New York. The failures of Silicon Valley Bank and Signature Bank, or any bank for that matter, could potentially impact the Federal Reserve's policy decisions in regards to raising the Fed funds rate, which is the interest rate at which banks lend to each other overnight. If the failure of Silicon Valley Bank, or SVB as they say, leads to broader economic problems or a loss of confidence in the banking system, this could cause the Fed to delay or even reverse plans to raise interest rates. This is because raising interest rates in a fragile economic environment could exacerbate problems and slow down growth. However, it's important to note that the Fed's decisions on interest rates are based on a wide range of economic indicators, not just the health of individual banks. So while the failure of SVB could be a factor in the Fed's decision-making process, it's unlikely to be the sole determining factor. In terms of mortgage interest rates, the impact of any Federal Reserve policy changes on mortgage rates are indirect, but significant. If the Fed raises interest rates, this can lead to higher borrowing costs for banks, which can then be passed on to consumers in the form of higher mortgage rates. Therefore, if the Federal Reserve delays or reverses plans to raise interest rates due to the SVB failure or other economic concerns, this could help keep mortgage rates lower than they otherwise would be. I'm Ian Lozada from Keller Williams Realty Elite.